Question relates to a service called Morningstar. There's another one called Value Line that is very similar. And they're really good services because they are independent, for one thing. They're not linked with any brokerage firm or advisory, okay? Although well, let's just leave it at that. They rate mutual funds and stocks on timeliness and safety. And they're fine services. And they may be helpful to some people. They provide a second opinion. You know, you may have an opinion about something, and if they might support your opinion, or if you think, wow, this looks like a great stock, and they say no, that it's a very risky stock, and the worst time you ever could buy it is right now, so don't do that. But again, this is an opinion. Morningstar and Value Line are both subscription websites, although they do both have a tremendous amount of free access, a lot of free content that is available to you. The other thing is if you live, and I apologize, I'm not 100% sure on this. I don't know if it's in the city of San Diego or in the county of San Diego, and you have a library card, you have access to the full website without having to pay to use it. So that's worth getting a library card, in my opinion, to do that, because they both have a tremendous amount of very good educational information on them. They are very, very good. Yeah, the question is, what about socially responsible investments? This has become a very popular investment strategy for a lot of people. There's a couple of resources. As investing in general has the S&P 500 stock index, there's a socially responsible index called the Domini, D-O-M-I-N-I, the Domini 400 index. And these are companies that meet certain social criteria. No tobacco companies, no alcohol companies, no gun makers, no maybe not even car companies, no defense contractors and stuff like that. They're all companies that go through a number of different screens. And it used to be that if you were investing with your heart rather than your head, you would expect, well, maybe I won't get quite as good a return, okay? Well, a couple of things have happened. Number one, more and more companies have become socially responsible. And so their index, if you were to look at the Domini index and compare it to the S&P 500, you'd see that there is a tremendous overlap between the two. So there's a number of others. Calvert is a family of mutual funds that all of their mutual funds go through a socially responsible screen. See, what's difficult about that for me is that socially responsible to one person is different than socially responsible to another person, okay? Somebody may not be opposed to having tobacco stocks, owning tobacco stocks, okay? That I don't smoke, so that's of no interest to me. But when I look at tobacco companies, because they all pay good dividends, I could say, if from a pure investment strategy, these would be good companies to own. But my social screen says I can't do that. Okay, so everybody's a little bit different, and everybody has a different socially responsible screen. So there's plenty of choices out there. Almost every family of mutual funds now has at least one socially responsible portfolio that you could invest in. Now, in all fairness, there's another mutual fund out there called the Vice Fund. And it has everything in it that socially responsible companies won't hold. Okay? It's got all the tobacco companies, all the booze companies, everything you can think of that's terrible, they own these stocks. And I apologize to say, but that fund beats the stuffing out of socially responsible funds. So go with what works for you. That's all I can tell you on that. So, thoughts on buying gold and silver. I never discourage anyone from owning precious metals. Never, ever discourage anyone from owning precious metals if that's what you want to do. I think most of you are here because you kind of want to know my opinion about stuff. I would never own gold or silver, personally. Okay. First of all, I love dividends, and just owning a metal does not generate any income. It's a very passive investment that doesn't do any good. And this isn't my first rodeo. I've been through a lot of economic cycles before. I remember back in the 1980s when gold really made its first big move, got up to $800 an ounce. And there were a lot of people out there. Pat Boone, yeah. Huff. What's the guy's name? Huff. Anyway, not Ruff. Howard Ruff. Howard Ruff. They were saying, you know, it's $800 now. You better buy it because it's going to $2,000. Okay, and they were right. Okay, it just that they missed it by 1 decimal. It went to 200. Okay, it dropped back to 200, and it took 25 years to go from 200 back to 800. Now, if you want to own gold because you're worried about global situations, geopolitical situations, economic crises, and things like that, please go ahead and own it. That's absolutely, absolutely fine. But be aware that it's going to be extremely volatile. And we've seen gold go. You know, it was 2 years ago, gold was at $1,900 an ounce. It's now below $1,300 an ounce. And people were told when it was at $1,900 an ounce, you better buy it because it's going to go to $3,000. Okay, so I don't know. It's a little bit more volatile than I'd like to be involved with. Will there be a correction? Absolutely, there will be a correction. Yesterday, I happened to be watching CNBC, and there's a anchor on there called Kelly Evans. She's relatively new, and all of this, whether it's Bloomberg, or Fox Business Channel, Bloomberg, CNBC, they love to interview people who are calling for the end of the world. Okay, that's what they love. Okay, so they had Jeremy Siegel on. They had Jeremy Siegel on yesterday. Now, Jeremy is a professor at the Wharton School at University of Pennsylvania, one of the most knowledgeable guys. I told you about his book, Stocks for the Long Run. He is a very bullish guy. The Dow Jones Industrial Average today is around 16,000 something. He says by the end of the year it'll be 18,000. He explained to this anchor why he believes that. And she goes, whenever a reporter or anchor begins with this expression, you know they're ready to insult somebody. And she said, with all due respect. And she quoted then another guy, Robert Shiller, who has said stocks are ready for a big correction. And Siegel came back very quickly, very calmly, refuted what Shiller believes. And he did it extremely well. And she just sort of like said, you are so wrong, Dr. Siegel. And then today, I happen to be watching CNBC again, and she's interviewing some other guys about, you know, the banking industry, and she goes, well, you know, Siegel said we're not going to have another bank crash, and she couldn't let go of this thing. She just couldn't stop beating up this guy that's bullish about the stock market. Okay, I don't know if, you know, stocks don't go up forever, trees don't climb to the sky. Stocks don't go up forever. There will be a correction. We're long overdue for some kind of correction. I wouldn't mind a correction, okay? It's nice to, on your reinvestment programs, to stop reinvesting those dividends at all-time highs. I wouldn't, since I'm in no hurry to sell stocks, I wouldn't mind if they went down and I could reinvest when the stocks are lower and I get more shares when I reinvest my money. But I'm not going to worry about it, okay? Stocks go up more than they go down. Okay? I don't know when they're going to go up. I don't know when they're going to go down. I don't know what they're going to do from one day to the next. All I know is that over time, stocks do extremely well. And if you let your emotions get involved with it, you're a goner. You should not be investing. If you're going to let your emotions get involved, stop. Don't even do it. Okay? And that's maybe where a pro does come in to help you. And that's why you should talk to the folks of the credit union about this as well. Another investment category that a lot of people like are what are for income are called real estate investment trust, or as they're known, REITs, R-E-I-T, REITs. A REIT is a public company that invests in different types of real estate. They're usually specific to one type of real estate. There are apartment REITs. They have been red hot for the last few years as a lot of people were forced out of their homes because of the crash in real estate, and so apartments have become very hot. All you have to do is drive around San Diego County. You see the big, really large apartment projects that are being built around here. So there's apartment REITs, there's hotel REITs, there's commercial real estate REITs, there's prison REITs. Most prisons are owned by publicly traded companies now. And so last time I checked, most prisons were working at least 100% occupancy. Okay, yeah, maybe even a little bit more than that in a lot of cases. So if you're running if you run a hotel, you're real happy when you got 70% occupancy. Okay, now you got a prison and it's running at 120% occupancy. That's not a bad investment. Okay, again, your socially responsible genes kick in at that point in time. Do you really want to own a prison? Okay, but they've actually been pretty good investments as well. Now a REIT again just is a specific pure real estate investment. It is also what is called a pass-through investment. Companies are required to pass, we were talking about the payout ratio on companies, 30, 40, 50%. Payout ratio on a REIT is usually 95%. They are required by law, the structure of the investment is to pass 95% of all of the earnings directly through to the investors. You lose the tax benefit on that dividend is taxed as ordinary income. But we have some really good REITs that are headquartered here in San Diego. I won't mention any by name, but they are some really good ones. You could do a little detective work and find out what they are. There's some very, very good ones here in San Diego County. Yeah.
Why was that 95% bad? Because earlier you said also the
Well, you don't want a company to pay out a normal company, not a REIT. You want to keep that payout ratio at 50% or less, okay? Because you don't want them, they can use the rest of that money to grow the company and do stuff like that. The way a REIT is structured by law, they have to pass through 95% and they keep 5% or so to administer the company and make new investments and stuff like that. Yeah, for a REIT, that's great. Yeah, you don't mind a 95% payout ratio on a REIT. Okay, especially when you get the check.